A very good evening to you all, friends.
Recording in
I'm
progress.
I'm Sanjeev Singhal, Central Council member and Chairman of the Auditing and Assurance Standard Board and Sustainability Reporting Standard Board. I, on my behalf and on behalf of my Vice Chairman CA Vishal Bhai Doshi ji, welcome you to this 58th program of the Auditing Standard Board for this council year. Friends, as you know that this year we are in a mission mode that we'll take the auditing learning to the doorstep of every member. We started with various auditing standards, and then we moved on to Schedule 3 and CARO. And now we are discussing how to audit particular items in a balance sheet and in the profit and loss account. In this direction, today's webinar is focused on audit considerations while auditing investments and financial instruments. These are very, very important elements of any balance sheet. And we have with us two very distinguished speakers, CA Priyanshu and CA Amit Jain. And we express our sincere thanks and gratitude to both of them for taking up this highly specialized area. And friends, it's indeed a matter of pleasure and pride that our keynote speaker for the day is none other than our very own and beloved past president, C. Nilesh Vikramasinghe. And it is probably a coincidence that when he entered the council, he has taken up this project on financial instrument from the India side. That time I used to be a co-opted member of the Accounting Standard Board, but he was the one who has taken up this difficult area. And I can tell you that he's an excellent human being. You will find him by your side whenever you need him. And he's a senior partner of KKC and Associates LLP, which is formerly known as Khimji Kovarji and Co LLP. And the firm is in practice since 1936. Sir himself is a member since 1985. He has done a certificate course on the forensic accounting and fraud detection. He's a diploma in information systems audit and business consultancy studies course of the Bombay Chartered Accountants Society, jointly with Jamna Lal Bajaj. And I said, he has been the highest torchbearer of our profession as the president of the Institute of Chartered Accountant of India. And he has been on the advisory committee on mutual fund of SEBI. He's been nominated by the central government to the board of governors of Shri Arun Jaitley Institute of National Management, erstwhile known as NIFM.
Sanjeev, it's enough, I think. No, Sanjeev, that's enough. To this audience of chartered accountants, I think that's enough.
Right. Sir, actually, all accountants know you, sir, and we really hire you in many companies. And thank you for taking out time for members as always from your busy schedule. And I remember my meeting you in London recently, and it's been such a pleasure meeting you every time. And sir, I invite you to kindly deliver your keynote address. Thank you, and over to you, sir.
Thanks, Sanjeev, and thanks the Auditing and Assurance Standard Board of the Institute for giving me this opportunity. And first, let me compliment you, Sanjeev, especially, and Vishal and the whole team, Anil. 58 sessions on auditing standard and related areas. I would say it is unbelievable. Just the year has just begun. I think the council's term has started in February in hardly 4 months, and I'm sure you should create a record of more than 365, more than a year. Minimum one program a day, and more than that, one should be doing it. And wish you God's strength. And this is one area auditing. I think we as members have neglected. I'm talking of the mid-size and the smaller firms, the general practitioners as we call, because there's been so much pressure of tax, GST, new laws coming in. So though we do audit, but somehow our focus has been in the context of audit has been on the tax audit, the taxation law, GST audit, the GST, and as far as corporate audits and all are also concerned, more focus on accounting standards with lesser focus on auditing standards. So I think that needs to change, and I think the whatever we can do as institute, I think we should be doing as far as these outreach are concerned, and see to it that the members are aware. Now we are signing off in the Companies Act saying that the audit report that the audit is in compliance with the auditing standards. I don't know how many of our colleagues are really going through. And I'll tell you my own experience, and this is true for larger firms also, not only the small and mid-sized firms, is we do compliance with the auditing standard, but the expectation of the regulators, especially NFRA, has just shot through the roof. And the expectation is, if, for example, you take a judgmental call as a professional and you sort of, certain things are not applicable to an entity. But I'm just giving a small example of the NFRA orders, is that you need to document that why a particular line or why a particular para is not applicable. Now that is going to a different level of expectation, which I think is very, very challenging. So my earnest request to all the listeners, please focus on standards of auditing, compliance, documentation, whatever Sanjeev and team are doing. Grab the maximum benefit out of it and see to it that whatever. See, we are just like that Ayurvedic doctor. We know the nubs of the client, but that is not enough. I'm saying with the regulatory environment, we need to document it. You may have it in your head, but that will not be good enough. Coming to the topic of the day, audit considerations while auditing investments and financial instruments. Again, as Sanjeev said, it is very, very coincidental. This is one area where I have been, very sort of closely connected with number of clients on the banking side, the BFSI side, and so on and so forth. And more importantly, like Sanjeev was a co-opted member of the Accounting Standards Board. I remember during 2008 or earlier, I was also a co-opted member of the Accounting Standards before joining the council. And I was, one project was given to one of my colleagues, one of our fellow professionals in Mumbai, to merge three standards, give a particular draft after merging then IAS 39, IAS 32, and IFRS 7. The three standards which were prevalent at that point of time, prior to the global financial crisis. And but somehow that merging those three standards was not anybody's, it was not an easy task. And the colleague of mine, when I say colleague, one of our fellow professionals, was not able to move ahead in that. So finally, the mandate came to me. I was made a convener of that particular group, and now the ASB changed the view, and they said, "Okay, let's bring out those standards as they are." After reviewing it, let's review the international standards. What modifications we need to do in India? And friends, believe me, I'll just give the names of people who were involved in that particular study. Myself, then Abhijit Diwanji, that time he was part of BSR. Ashutosh Pednekar of MP Chitle, Jayesh Gandhi, that time partner of NMRIT, now partner of SR Batley Boy. So four of us, and later on it was joined by another very nice professional called V. Venkat Raman, who's a partner of BSR now. And that time he was director or whatever the designation was. And believe me, the amount of struggle which we have had in bringing in those standards, reading it line by line, understanding, and these are very, very typical standards. Even the erstwhile standard of IFRS 9, which was that IAS 39, language is horrible. This is European English. And we sort of did a lot of track change in that particular draft standard so that it is good for the Indian, I would say, people we can understand the English better. Unfortunately, those efforts were not, successful, as we were told by the then ASB chairman and the ASB that let's not make the language change. You put in a lot of efforts to change that to make it more user-friendly to the Indian readers. And possibly at that time, again, the first time this particular three standards were taken to the council only by a presentation of the group. Our group presented to the council. They had a meeting in Mumbai at the old corporate office. Otherwise, till then, each and every standard was read line by line. And I believe the then ASB chairman would have realized that if this standard goes for line by line reading in the ASB and in the council, it's never going to see the light of the day, the way it is so complicated. And we made a presentation over 2 days. I remember this group. A lot of firing from very senior colleagues like Vinodji and all. Vinodji was later on my council colleague, Vinod Jain. Very good inputs from another council member at that time. And I was just a co-opted member, Akshay Khanna from Akshay Gupta from Kanpur. And all these memories are coming back. And based on that presentation, the ASB discuss, council discuss was brought to the council. We had that AS, I think, 30, 31, 32. These were recommendatory, not made mandatory. Those came in. And then based on that study group was given the mantle. Then the global financial crisis happened. And again, friends, just to give you a background, what happened was, this is again a unique standard, the IFRS 9, which is IAS 109 is again a standard. I don't think in the history of accounting standards where a standard has come out in piecemeal. IFRS came in piecemeal. There were 3 sections, and the 3 sections came at different points of time. It didn't come holistically. It was so complicated. Post the global financial crisis, the mandate to IASB was the IAS 39 was not conducive. Whenever the problem happened, it only accentuated the problem. It didn't anticipate the challenges. What we have the expected credit loss now. So it didn't anticipate the challenge, and the accounting was not proper. It was not correlated with the market and all those things. So based on that, and whether the accounts are being shown true and fair. So again, a unique thing where the standards came in 3 different pieces. We gave response to as a group, we gave response to the international exposure drafts. So, whatever suggestions were there, we went to the ASB. And finally, when Ind AS was implemented, these 3 standards were implemented. And I think there's one carve-out which we have in this standard compared to international one, where we don't fair value the liabilities. That is then the international standard. It goes. We do fair value, so we do fair value, but internationally the standard goes to P&L, and we are saying it go to the reserves. So that's one change which, based on the suggestion of the group, the council also felt it was right, and that was brought in. And so that's the background of this particular standard and my connection to this particular area. Friends, our topic today, I believe, is going to be under Ind AS. That's what I've been told, not under the old standards, not under the accounting standards. It's going to be on the Ind AS. And here again, friends, the auditing brings in a huge challenge. It is basically everything has to be fair valued under Ind AS. And how do we fair value? For example, there are, again, I'm now talking about accounting, and then our friend Priyanshu, I'm not going to speak on auditing, that I'm going to leave it to you. So the problem is, I'll do the easy part just to give an overview to the members. So it says level 1, level 2, level 3. How do you fair value? So level 1 again is where you've got absolutely the same instrument is quoted somewhere in a market. And so there's no challenge there, if it is sort of a liquid instrument. Then level 2 is, where it is an observable inputs are there. Similar instruments. Say you have got a corporate bond or similar credit rating, etc. And there's some other bond listed. Your bond is not listed, your investment or... So how do you value it? So there are comparable things available, and then you talk sort of value. Level 3 is where there is no observable data. Then how do you value? So especially, maybe let's take the case of unquoted investments and all. How do we fair value, so on and so forth? So that's one challenge which comes around the auditing. How do you audit these type of things? Where there's level 1, I think it's easy. Level 2, level 3, how do we do? I think our friends Priyanshu and Amit are going to guide us how to look at these things. The other challenges which come up, I think again, this from this standard perspective, I'm saying from an auditing perspective, which could come up and which we'll take guidance from Amit and Priyanshu is, number one, the issue of recognition of the assets or the liabilities. And it's not only financial, it could be liabilities also, it could be assets also. Assets predominantly, but liabilities also. Assume whatever may be your cost, you have to fair value on day one. So there could be a possibility of difference between your cost and the fair value. So how do you look at that? Then assuming you're selling of the asset, when can a derecognition happen? And here I'll just give a small my friends will give more examples. Is look at a typical NBFC or a housing finance company or whatever. They have got a portfolio, and nowadays they securitize the assets, they assign the assets. So how do you, whether the control goes out, whether the risk and rewards are going out? At what point of time one will derecognize? So there are issues around that, auditing issues around that. There are income recognition issues around that also. For example, say your average yield when you book the assets for example, is let's say 12%, and you're selling off at an effective yield of say 9% to those particular portfolio of assets. So the standard says that you have to recognize the whole income upfront. Say that asset is going to be for 5 years. So you need to recognize. So the question is, what in case the asset runs off faster than that? So do you keep on? So there's a lot of volatility involved. Say it's a 5-year remaining period of a housing loan or 7 years. And thanks to the reducing interest rates, there's a runoff on the assets. And there are only, so you de-recognize that. So there are issues around that. There are issues around service fees on collection in case there is something like that. And then there are issues of derivative accounting and hedging again is sort of the accounting itself is there of course there are plain vanilla products which are okay, but there are complex derivatives which are also there. So that how do we account for that? How do we audit that? The accounting has been done, but how do we audit that? Is the auditing all right? Then there are issues around impairment of the asset. What earlier we were saying provision for doubtful debts or provision for advances. Now the terminology is expected credit loss, and this is a huge area in itself. Your estimation, the day one, assessment of the loss, 12-month post, what are the losses we are anticipating? More importantly, just to give a flavor to the members, when COVID happened, you have to estimate, what is going to be expected credit. Expected credit, what is the expectation? This came in only because of the global crisis. Earlier, we used to provide for a doubtful debt only when the problem happened, when the asset became non-performing. The impairment happened then. Now it says you have to estimate how your portfolio is going to perform. So day one, you need to make some provision. So what we normally call it a standard provision, standard asset provision in a typical old AS terminology. Now it is an expected credit loss. So day one needs to estimate what will be the loss. The challenge which came up recently in the last 2 years is the COVID has completely distorted the repayment patterns of the people on the loans. So that also has to be estimated. There has to be tweaking around that, and how do we audit that? That I think again our colleagues will give some sort of flavor around that. Similarly, when do you recognize the gains or losses when the control and the risk rewards move out? Hedging, as I told you, is a big area itself. So I think a lot of issues involved. And friends, I will want to conclude. I will not want to steal the thunder from Priyanshu and Amit. And again, I have not spoken from an auditing angle. I've spoken from an accounting and problems angle. So solutions will come from that. I have been telling when the standards came in that these standards itself are a full practice area. The financial instrument standard, I'm saying from an accounting perspective. Now, I can say the same thing as far as auditing concerned. These standards itself are a whole audit, practice area. So please listen carefully to Priyanshu and what Amit are going to say. And I'm sure, you will have a lot of inputs, and those youngsters who are interested, I think there's a huge potential in this area. The Indian markets are still nascent as far as financial products and instruments are concerned. As we gain more knowledge and as Reserve Bank becomes more, sort of confident, newer products are coming, and this markets are going to grow as far as derivatives, so hedging, commodities hedging, so on and so forth. So I think there's huge opportunity which lies in front of us in this area of practice, accounting, advisory, as well as auditing of financial instruments. So with that, I would want to, conclude my initial keynote remarks with this preamble, and now over to you, Sanjeev, for taking it forward.
Thank you so much, sir. You touched areas with such expertise and depth, and because you have worked on this area, as you have all also said, because it's a very, very complex area, and this AS 30, 31, 32, they never became mandatory. So those who have been following the earlier gap actually say they don't use it. So you're right that today also it's a separate practice area. It has become a separate practice area. And there are many areas under Ind AS which have become separate practice areas. So that is why we thought that let us deal with each such area in a separate webinar. And thank you so much for the insights that you have given, and your love and affection for the profession, as always. Thank you so much, sir. Thank you. We now move to Priyanshu and Amit.
Sanjeev, I'll need to excuse myself.
Both of you, and thank you.
I would have loved to listen to Priyanshu and Amit, but there are some other commitments I'll have to excuse myself. So I'll see the recorded version later on. Yeah.
We understand, sir.
Thanks a lot.
Fully understand, and thank you so much for time. And Priyanshu and Amit, thank you for taking out time, and it's over to you. We invite you for your deliberation in whichever order you want to speak.
Yeah. So I think then thank you very much, Sanjeev sir. Thank you very much, Nilesh sir, for your inputs and guidance. So I think I'll start first. I mean, as per the order. So I'll talk about auditing investments. So I'll just start sharing my presentation and then talk about it. So good evening, friends. First, let me thank Nilesh sir and Sanjeev sir for their inputs and setting the tone for the two sessions. As I start forward, I think the first part, what I'm going to take is on audit considerations while auditing investments. So before I get into the actual audit of investments, what's important is we need to understand the the main background and definition in terms of what investment means. So I'll touch upon that. Then I'll also touch upon the accounting aspects, as Nilesh said, that how complex sometimes a simple investment can be at the end of the day, the way we account for it. So I'll touch upon the accounting aspects of the investment, and then I go to the auditing aspects, where once it's accounted for, how you actually audit that, because the financial statements are given to us by the management. They have accounted for a particular transaction as investment in different categories, and we need to actually audit those investments. So I'll touch upon that. And while I'm talking about audit, I'll divide that into three parts. One is our requirements to report in the main audit report, which is the 11 clause. Talk about CARO 2020, where we as auditors have to report from an investment standpoint, and the audit procedures generally which we need to actually follow as per our auditing standards while auditing investments. So let me move forward just to touch upon the background and the definition of investment. Now, I mean, it looks very simple. What is investment, kind of it, but when we actually drill down, I mean, there is a method to madness around it. What is an investment? Investment is an asset. It can be any asset which has been held by an enterprise in order to earn income by way of dividend, interest, or in some cases rentals, or we hold that investments for capital appreciations or long-term benefits, which at the end of the day would flow into the investing enterprise. Assets which are held stock and trade, which may have a similar kind of what you call a legal parlance, but cannot be considered as investments if it does not fit into the definition, as I said. As I move forward, I mean, investment is generally classified as long-term investments and current investments. But then it's further classified when we look at any of the financial statements or Schedule 3 or Ind AS. I mean, it's classified as investment in subsidiaries, investment in associates, investment in joint ventures, joint control operations, and other investments such as equity, debt, fixed deposits. I mean, which is more likely fitting into Ind AS 109, which CA Amit will take in the next session. So let me just touch upon the definition. I mean, investment in subsidiary, I've tried to put across the definition both from Indian GAAP perspective as well as Ind AS. I think if I look at Indian GAAP, I think it's quietly very simple to say that, okay, subsidiary and enterprise which I control, parent is a company which has more than one subsidiaries. How I define control under the old GAAP is that more than 0.5% of voting rights, which is like 51% voting rights with me, or I have a control over the board of directors. But when I look at Ind AS 110, I mean, the definition and the interpretation goes beyond the legal documents which we have on hand. So it does not talk about having 51% of voting rights as one of the criteria. What it talks about is how an investor controls that particular entity. And they have actually defined what that controls means. It talks about the variable return. It talks about the rights that investor has. So if an investor may hold, say, less than 51% voting rights into that category for a particular section, or equity rights which are lower than 51%, but if he controls the particular activity by saying that they have a veto vote for any particular transaction above a particular limit, or they have exposure to variable interest. So there are conditions attached to declaration of dividends or payment of interest, etc. kind of it. Or they have an ability to affect those returns to say that, okay, while I may hold 10% in equity, but I have economic interest of 90%, etc. So all these factors needs to be considered when we are actually establishing control. And why this is important is that based on those factors, once you have established control, then only you can determine if that particular entity is a subsidiary of a parent or not. As I move forward, I think associate also, I think more or less it's similar. I mean, you need to have significant influence and not control. So again, I go back to the control definition to say that, okay, if it does not fit into the control definition, and if it does not fit into the subsidiary definition, it automatically fits into the associate definition in a straightforward transaction. But when I look at joint ventures, I mean, so if I look at joint ventures, investment in joint ventures, again, from an AS 27 perspective, it's fairly simple to say that it's a contractual arrangement between more party, which is subject to joint control. They've agreed to share the control in an economically activity way. It is governing the financials and the accounting policies together. I mean, the kind of joint ventures which we have is joint control operations, joint control assets, joint control entities, etc. When I look at Ind AS 28, I think the way they have defined joint control is that it is a contractually agreed sharing of control of an arrangement which exists only when the decisions about a relevant activity requires unanimous consent of all the parties sharing the control. So here what is important is that all the party has to agree to a particular decision to move it forward. That's how India is defined joint controls. And of course, joint venture is like a joint arrangement whereby the party that have joint control over the arrangement will have rights over the net asset of the arrangement also. So that's how it particularly works out to be. If I look at investment in others, I think this is morely defined under Ind AS 109. It talks about financial asset, which will be covered in our next session. It's basically to say that financial asset is any asset which means that it is a right to receive cash or another financial asset from another entity, to exchange financial asset or a liability with another entity with a condition that may be probably favorable to the entity, or a contract to particularly settle that particular equity instrument in certain transactions. So if I look at the examples of financial assets, they are investments in equity instruments, I mean, which may not be classified as a subsidiary, JV, or an associate. Investments in debt instruments like what we have, NCDs, which we have, CCPS, the way you classify as equity or debt. I mean, but it hits your investment. Then you have preference, non-convertible preference shares. It's a shares, you show it as an investment under Schedule 3 Companies Act. Ind AS says that it can be classified as debt. And normal financial assets like trade receivable, cash and cash equivalents, and the derivative financial assets. Let me touch upon some of the accounting aspects of these investments before I get into the actual auditing part. So investment in subsidiary, I think accounting under AS 13, which is our Indian GAAP, I mean, very simple. It includes the cost of acquisition, includes the brokerage, fees, duties. You either pay it through cash, or if an investment is acquired by issue of shares or other securities, which is in kind, I mean, to some extent, I think the acquisition cost is accounted on fair value basis. If it's rights issue and if you subscribe on it, it goes to the carrying amount of the original shares, but if it's sold, the sale proceeds is treated as income and credited to profit and loss. I mean, what income which we earn from investment, be it interest, dividend, rental receivables, etc., goes to the P&L. If such interest dividend is earned before acquisition, then it gets reduced to the cost of investment. The carrying, again, the value is simple, lower of cost of fair value. You look at long-term investment and see if there is a decline other than temporary, then you take that hit into the profit and loss account. When, of course, disposal, when the investment is sold, the difference is in between the carrying amount and the net sale value goes to the income statement. If it's partly disposable, then accordingly the cost is arrived. The reclassification, of course, investment from long term to current happens at lower of cost or carrying value, and from current to long term it happens either lower of cost or the fair value of the date of the transaction. So these are fairly simple accounting under AS 13. In terms of disclosures, straight, you need to disclose the classification, the accounting policies, the amount included in the profit and loss account for the income which you have earned on the investments. Any specific restrictions on the right of ownership needs to be disclosed. You need to disclose the aggregate amount of quoted and unquoted investment and any other specific disclosure if it's required by any other statute. So that's all the disclosure is. If I look at from an Ind AS 110 perspective, I think first foremost is that we actually have to look at the investment is in subsidiaries, either its cost or it's covered under Ind AS 109. Okay, entity shall apply the same accounting for each of the categories of investments. Whatever income which you account, you need to account for in the financial statements as profit or loss, whatever it is. And if you receive dividend, you need to account when the dividend is received. The right to receive the dividend is established. So in our case, if it's the board of directors declaring the dividend, is that the date of the rights, or AGM if it's a final dividend? I mean, in terms of disclosure, I think it includes the composition of the group. So I'm looking from a consolidated standpoint. Interest that you have on NCI, so that needs to be disclosed separately. We need to evaluate if there is a significant restriction on the ability to access or use such assets. I mean, in terms of is that pledged or not? What are the risks associated with those entities and our interest associated to that particular entities? Is there any change in the ownership which is not resulting to the loss of control? And if there is a change in ownership which results to a loss of control, then you need to look at it, how the accounting would look at it, and also need to evaluate from a discontinuing operation standpoint also. I mean, just a fact check. I mean, if I take an example where entity H holds say 40%, it does not mean that it holds more than 50%. But there are 6 other investors who hold 10 each. Now, this 6 investors says that okay, we will sign an agreement where we give that powers to entity H to appoint, remove, settle, set remuneration of management, and take the operations in their hand. Okay, and to change that particular agreement, you need a 2/3 majority vote. So in this case, since entity H hold 40%, probability of 2/3 majority vote may be very difficult. So in this case, if I say that entity H holds power in entity S, yes, it holds. And the reason why I'm saying is that, okay, you can't only compare 40% to 60%, because first is entity H has rights and has sufficient power to take decisions. Okay, entity H has a contractual arrangement with other shareholders. The contractual right gives them to appoint, remove, and set remuneration. Okay, and as I said that even if entity H does not exercise those rights, but still it has powers, I mean, we need to consider entity S as a subsidiary. Let me move on to investment in associates and accounting under AS 23. I mean, it's fairly simple. You need to account for as equity method. unless that investment is carried for as basically held for sale, or there is a long-term restriction on that particular investment, which may trigger to a impairment and its ability to transfer funds or to the investor. So unless and until these two criteria are not there, you need to account for that as equity, right? And again, equity method, you account for as cost, identify goodwill capital reserve at the time of acquisition, carrying amount of investments, you post acquisition, you adjust it to the net asset of the investee, and whatever results from operations comes in for that particular year. Of course, disclosures, again, it's a simple. You need to have the list and the descriptions of associates, the investment in associate accounting for which method, which is equity method, should be classified as long-term, disclosed separately in the consolidated balance sheet. Investors' share of profit and loss account on such investment should be disclosed and separately in the profit and loss account, the name of the associate and which reporting different. If the reporting periods are different for the associates, you need to bring that into the fact, and also if there is a accounting policy differences being followed between the associate and the holdco, and it's not possible to marry those accounting policies, then that fact has to come into the policy and accounts. Joint control as operations, again, we pick up our share of joint control operations into our books. And it's accordingly accounted for. The contingent liabilities are accounted for to our share of control. The assets are accounted accordingly. The expenses are accounted accordingly, right? Again, the same disclosures as I said under joint control. You need to account for contingent liability, which is our share. You have to account for capital commitment, which is our share. Only here, what is important to understand, if there is an agreement to say that all the losses will be bear by one party, then accordingly that accounting would change to say that whatever fund inflow is required or that losses needs to be taken to our consolidated financial statement of income or not. So that agreement plays a very important role in terms of how you pick up your share in the joint control. If I look at accounting under Ind AS, I think 28, which is fairly simple. You first need to do the test of if you want to account for its cost or in accordance with 109, which is fair value to profit and loss account or fair value to the OCI. So that's a policy which you need to decide at the day one. Okay, the carrying amount of investments, of course, will be accounted under the equity method. The goodwill will be included in the carrying value of the investment. The negative amount of goodwill in case of consolidation needs to be taken to P&L if there is an adjustment around it. And if there is a discontinuing operations, of course, I mean, that accounting would happen that way. When I look at an impairment loss under Ind AS 20, if there are indicators as per Ind AS 36, then you need to apply those indicators on the investment in associate. Because goodwill is part of the investment in associate, it cannot be separately tested, but instead you need to test the goodwill, which is part of the overall cost of the investment, and the whole impairment indicators would apply on the overall cost of the investment. I mean, if I look at just a fact check on how the accounting is to be done, I think here what we are trying to say is that company AB hold investment in subsidiary and associate. The subsidiary piece, can they account for at cost, and investment in associate, can they account for as fair value through P&L? Of course, under Ind AS 28, you can make a policy choice to say that, okay, I will account for subsidiary at the carrying cost and investment in associate as financial asset under 109 in the and take it through fair value through P&L. Another fact check in terms of how the transactions between associate or JV can be eliminated. Of course, it is fairly the profit or loss or the transaction between both the party gets eliminated to the extent what our share is, and the balance sheet to that effect get adjusted either at the investment and at the JV or the associate level, or you do it at the console level. Investment in others, I think this is just a snapshot. More details would be covered in the next session to say that how you account for investment when it's in under Ind AS 109. I mean, you look at a chart to say that if you are going to hold that particular investment, and if it passes the test of return of simple return of principal and interest, okay, then it accounts for as amortized cost, right? And if it does not, one sec. Yeah, and you hold on maturity, then it goes to amortized cost. If that business model does not work, that you're not going to hold it, then you need to look at it from a different way. Are you going to sell it? If you're going to sell it, then again you look at the SPPI test, and if the test passes through, then of course it has to be reclassifiable and it can be go to fair value through OCI. But it does not pass through that test, then it goes to P&L. If the business model is on trade, then it has to be fair value through P&L. So this is a broad charge in terms of how you account for investment which falls under Ind AS 109. This generally talks about how amortized cost has been calculated, how you apply the effective interest rate method. So any fees which you pay or any charges which you collect, it gets adjusted in a way that your overall interest rate is adjusted, and then you calculate an effective interest rate, and that's how the revenue accounts for in each of the years basis of the life of the instrument. Again, it's the same which I discussed. I mean, debt instrument you classify through FC fair value through OCI. If it's the hold, collect and then sell, and you are able to satisfy the specific principal plus interest test. Equity instrument you can classify as part of fair value through OCI or fair value through P&L. That's something, a policy choice you need to make at the start of the year. However, if the equity instrument is not held for trading, entities can make an irrevocable election to account for that as part of FCOI, because any change in the fair value unnecessarily hits your P&L and deflates your P&L on a year-on-year basis. Of course, there are financial instruments which are held as debt is not qualifying as amortized cost, or an equity instrument which is held for sale. I think the fair value goes to the P&L. I mean, just a fact check for, I mean, the dividend income, if an investment on a debt instrument has been recognized, I mean, you can either take it to P&L or FCO. I mean, it's a policy choice you have, right? In the point number 2, I think what we're trying to say is the parent A provides loan to subsidiary B. It's a no interest loan but repayable on demand. Does it meet the criteria of SPPI? Yes, it meets the criteria because interest is 0, because there is a percentage allowed. It's 0%, and there is a schedule for repayment which is on demand. So it gets classified under this particular category. This is something different. I'll just touch upon investment properties under Ind AS 40. This again talks about property held for capital appreciation or rentals, which means that properties held by us, which is not for use of your regular operations. In short, I mean, land that has long-term capital appreciation. You buy a land, you keep it. I mean, for long-term capital appreciation, that qualifies for investment property. Any land which you have acquired, you can't determine the use. I mean, that again qualifies for investment property. Any building which has been constructed to lease out both financial or operating gets classified under investment property. You have a building which is vacant and not going to be used for operations purpose. Again, it gets classified into investment property. Of course, investment property is accounted for at the cost to start with, plus the transaction charges. In case of finance lease, the fair value or the present value of minimum lease commitment is considered while comparing the cost of those transaction charges. Disposal, of course, it accounts as a differential. The net amount goes to the income. In terms of classification, you need to classify that as investment property. You need to actually mention the method and the assumptions used for fair value. Here, you need to disclose the fair value of the investment property by way of a note. You need to involve experienced valuer, as we say. You need to show it separately in the profit and loss account, the rental income, the operating expenses, and for the rented property, and operating expenses for the non-rented property. Any restrictions on realizability or property or remittance needs to be disclosed separately. So, I mean, this is just a fact check on investment property to say that if you purchase a vacant land and you want to construct a shopping mall, but since permission is taking time, I'm just trying to do some agriculture activity. Can I say that it's not investment property? But the fact check says that it has to be investment property because your long-term requirement is to build a shopping mall, and agriculture use is just incidental during the interim period. I mean, in the same way, I mean, the company purchases a big plot of land in the outskirts of the city, mainly the area where there's a low-cost public housing and very limited public transport. Government has planned, so you feel that the prices of that particular plot of land is going to go up. So you have bought it at a cheap rate and you want to hold on. Ideally, this has to be investment property because you are holding that particular asset on for capital appreciation, or you do not know how are you going to use this particular land in future. Now, since we have talked about investments, I think I'll move to the auditing aspects of these investments. And let me first start with the main audit report requirement, which is the 11E1 and 11E2 clauses, where if you look at it, we need to comment on two things. One is that no funds have been advanced, loans, or invested. So here the investment comes into picture to an intermediary, okay, which again actually lends those funds or invests those funds to an ultimate beneficiary. Or has company received any funds from any funding party for onward investments into ultimate beneficiary? So it is very important in these two clauses we have to report on it. So what it talks about it in the main audit report, what we need to look at it is basically the funding party in case of 11E1 gives any money for investment into an intermediary, and those intermediary has actually gone ahead and made an investment to an ultimate beneficiary. Okay, and if I look at 11E2, it talks about an intermediary who has received funds from a funding party, and this intermediary actually goes back down and gives that particular fund to the ultimate beneficiary. So this is where we need to report under Rule 11E1 and 11E2 in our main audit report. Okay, and what is the requirement for disclosure? And this is something which we need to ensure that the disclosure is appropriate in the notes to account as part of our audit procedures. Okay, and it's applicable to both the funding party and the intermediary, which is 11E1 and 11E2. You need to disclose the date and the amount of the fund advanced or loans or invested in the intermediary with the complete details of each intermediary. Okay, then you need to also say the date and the amount of fund further advanced or loan or invested by such intermediary to other intermediary or the ultimate beneficiary with the complete details of ultimate beneficiary. So here you need to also talk about your step down intermediary plus your ultimate beneficiary details also. So you need to put the whole chart in or whole structure into the notes till the time the ultimate beneficiary details are captured. Okay, you also need to give the date and the amount of the guarantee, security, whichever you have provided on behalf of ultimate beneficiary. Of course, you need to also look at a declaration and compliance with the FEMA regulations and the Prevention of Anti-Money Laundering Act. So, I mean, you'll have to look at those compliances also as part of our audit procedures. When I look at Caro, I think there is a requirement where we need to talk about clause 3, whether the company during the year has made investment, okay, to companies, firms, LLP or any other party, and if yes, okay, these investments are not prejudicial to the interest of the company. So here, if you look at two things, okay, one thing is previously, if you look at the CARO 2013 and the Companies Act, I mean, our requirement was to report of parties which are covered under the register maintained under Section 189 of the Companies Act. But now CARO 2020 has widened the scope, and the reporting is now required to report for all investment, loans, and guarantees. Further, we also need to evaluate if those investments are prejudicial to the interest of the company or not. That's where the audit conclusion actually comes into picture, right? So when we look at our audit procedures around those, and that's where we need to talk about it. I think what we also need to look at it is that before we conclude on how that particular investment is prejudicial or not prejudicial to the interest of the company, we also need to look at the management assessment first. We need to understand what is the control environment of the company, overall understanding of control, and also look at the operating effectiveness in terms of how those particular controls are effective or not. I mean, we also need to look at it. Are they evaluating from the purpose for which the loan has been given? What is the ultimate benefit of making those investments or giving those loans to those companies? To the giver, we need to look at those. I mean, what kind of benefits they have listed down? Is it permissible under the applicable law? The terms of the loans are not prejudicial. We need to look at it from a perspective saying that if I am borrowing money at X% and I'm investing or I'm giving loan at Y%, I think, are we trying to say that we are borrowing at a higher rate and giving it at the lower rate? I mean, there is a problem. So all these factors needs to be understood before we close on it. I mean, we also need to look at it, who approves those investments, right? We need to look at the compliance with different sections under Companies Act 179, 80, 85, 86, 187. We need to look at the RBI guidelines when it comes to NBFCs. Institute have issued guidance notes on audit of investments, loans, audit of liabilities. We need to look at those. There is a guidance note on CARO 2020 where they have actually put down steps in terms of what as an auditor we need to do while arriving at a conclusion needs to be look at it, right? As an auditor, we need to obtain all the investment details during the year, and those details should include the name of the parties, the relationship of the company with those parties, gross amount of investments made, in the nature of loan or date and amount of settlement, etc. So we need to capture all those details, including the terms of the contract, because that's also very important while we classify those investments. When we look at auditing procedure, I think what it's important is to look at 2 or 3 things. One is, what is the company's interest in making that investment? That has to come out very clearly, and that can come out by management note, and that note needs to be approved by the board. Okay. Then we need to look at, from a second thing, is that is companies having ability to make such investments, or there is a force behind the company to make those investments. What is the financial standing of the company in which you are making that investment is also important to note, because at the end of the day, we also need to know if the money is going to come back or not. Okay. Third thing we also important is, an auditor should know that when a company is making an investment, from where does the company is sourcing the funds? Okay. Is that fund source be traceable or not is important. Third thing is, at the end of the year, I mean, we also need to look at the valuation of that proposed investments and any covenant which are attached to it, right? I mean, when also we need to apply some judgment to say, I mean, if it's not uncommon that an holding company actually supports the financial position of a loss-making subsidiary company, and in that case, of course, the holding company would infuse equity, would infuse some kind of a loan, but that may not be constituted as prejudicial to the interest of the company because the holding company may have a larger interest in that particular subsidiary from a long-term benefit perspective. So all these factors needs to be considered. There is a lot of judgment around it. So we need to actually have meaningful conversations with the management to understand their particular business plan. Of course, we need to look at compliances with applicable laws and also, I mean, Companies Act requirements in terms of 186 and the approvals required by the board of directors. Let's look at auditing standards and let's talk about general auditing steps which we need to follow while we are actually doing the investment. Okay, our audit procedures, I mean, if I have to put it that, cannot be in isolation. It has to have the head and the tail, right? And what does that mean? It means that whatever I do needs to cover a risk. If there is a risk, then only I have to have that audit procedures done. And the second part is that what procedures I do needs to give me comfort on some or other assertion. Without that, it may not be helpful to do that audit procedures if I don't get that comfort from any assertion. So, I mean, let me just give you in brief, and then I'll go in detail as I move to the coming slides. I mean, if I look at, let me start with the risk. I mean, risk is what? I mean, investment may not be recorded completely or accurately in the correct period. Okay. Or the investments which they have made in debt or equity securities does not exist or it's unauthorized. Or investments are not properly classified. When you have de-recognized the investment that has not been accounted for properly. There are impairment indicators and that are not appropriately or timely identified are the general risk factors when we are auditing the investment. So when I look at those risk factors, I need to first and foremost thing, as I always say, is that we need to understand and evaluate the internal control of the company with related to how they are taking the investment decisions. Okay, right at from a tone at the top in terms of what is the control environment of the company, how the investment decisions are taken, what kind of companies management is involved for having those transactions. Then we move to the testing of those transactions where actually investment is happening. So we look at the supporting requirements to ensure that its accuracy, investment has actually occurred both for the new and the disposal investments. We obtain external confirmation, and I'll take you through that in a little bit of detail when I go through the next slide. Okay, then we look at external confirmation if that investment is pledged or has certain restrictions, which is very important because that comes as part of our disclosures. We look at the valuation of that investment at the end of the year. We also look at the interest income or any other income which are associated with its investment and has been properly accounted for either as part of investment cost or has been part of profit and loss account. So let me just touch upon the SF 500 and the external confirmation. I think when we look at external confirmation, I think audit evidence. I mean, if I look at SF 500, what it talks about is that audit evidence is more reliable when it is obtained from an independent source, which is outside the entity. It is more reliable when audit evidence is obtained directly by the auditor than by operating through a client or through indirect ways. And the third thing what is text, audit evidence which exists in a documentary form, whether in a paper or electronic or any other medium, is more reliable. So what are the audit procedures which we need to do as auditors while we are auditing investments? I mean, the first is we need to obtain confirmation from depository in respect of investment held by the company, either through demat balance, demat statement, bank statement, deposit statement. I think what is important is that when we are asking for this confirmation from the depository, I think we as auditors should write directly to the depository to requesting them to send those statements directly to us. We need to obtain balance certificates, interest certificate if that investment is through some banks, okay, and send a confirmation verifying those particular investments. Because if any investments are held by the bank for any reason, the bank has to confirm that the originals are with them. Okay. Of course, if the investment in form of bond, debentures, mutual fund issuer, we need to confirm the balance amount with the respective third party issuers. Okay. In case the original documents of the investments are pledged with third party for whatever reasons, then as part of our audit procedure, external confirmation is required to be obtained from that particular third party, which states that the original documents are with them and whatever confirmation we are asking ties up with the original documents with them. Also, the third party needs to confirm that the original documents are kept in a safe conditions. What are the other considerations which we need to look at it when we are actually doing an audit of investments? Verify whether the board resolution has been passed for the investment made by the company. Remember, 186 Companies Act requires pre-authorization by the board. Verify whether the investments are held in demat or in physical form, because that is very important. And what is the second thing? What is important is to see that the investments are held in the name of the company. And if the investments are not held in the name of the company, then what are the reasons why that investments are not in the held of the company? Evaluate RBI compliance, FEMA regulations if investments are made outside India for whatever reasons. You need to look at share purchase agreements because that's define the classification in terms of is it the subsidiary, JV, associate. Plus, it gives you an idea in terms of is there any restrictions on excess of the available funds, etc. Date of acquisition is also important because under Ind AS, how you account for the date of acquisition is actual money transfer or as per the share purchase agreement. I mean, you need to look at it in detail. Of course, you need to comply with the Ind AS accounting standard classifications. You need to ensure that the accounting policies of subsidiaries are consistent with the parent while performing the consolidation. This is a very important thing because somehow we miss out on this because we don't read the accounting policy. This is a basic requirement where your accounting policy needs to be aligned, okay, between the parent and the subsidiary. And any adjustment to that effect needs to be considered in the consolidated financial statements, right? You need to also look at it if any consideration has been received in cash or kind while disposal of investment has been appropriately accounted for in the books. So if it's received in kind, then you need to look at it from a valuation perspective, a fair value of that particular receivable which you have received in kind needs to be accounted accordingly. Okay. Let me look at specific consideration in terms of when you are actually doing the investment. Okay. Now when I look at it from a specific consideration from an investment perspective, the first and the foremost things which comes into mind is how do you test those impairment of that particular investment. And I'll have a slide after this which I'll just discuss, but just to give you a snapshot around it is that we need to first look around us. Okay, we need to identify events, changes which are occurring within the entity, its industry or economy, indicating the current value of investments. I think we need to also look at the external source of information which we have. I mean, just giving an example of in today's scenario, if I have to look at the Russia-Ukraine crisis, I mean, any company having an exposure in these two countries, I mean, suddenly needs to be reevaluated, re-looked at it. Even impact on businesses which has an indirect effect on because of this crisis. Like, for giving you an example of, say, because of this crisis, the prices of crude has gone up tremendously. That has a larger impact on various industry in terms of the cost part, because the input cost has gone up large, because of which there is an impact on the margin. So these things needs to be evaluated. This needs to be re-looked at it when you are actually doing your cash flows for the future, while you are testing for the impairments, right? Any adverse conditions, interest rate increase in market, which we are actually looking at it. I mean, simple thing where your carrying value of your entity's net asset is higher than the market capitalization. That's one of the triggering event in terms of you need to look at impairment more carefully. I mean, internal sources like, is there a physical damage or an obsolete in that particular asset in which you have made an investment? Significant changes have happened within the organization, restructuring. The business plan of the companies have changed to say that now they are not going to focus on certain set of products that has an impact. So all these factors you need to consider while actually testing the valuation assertion on the investment which is carrying in the books. Okay, you need to then look at the method which management is used for establishing the recoverable amount. You need to test calculation, which I'll just touch upon in the next slide. You need to check whether the investment has been approved by the board for sale, or when an investment is sold, the board resolution is there for that particular approval. Is the gain and loss on sale of investment accounted properly in the profit and loss account? Okay, if any investment is held for sale based on management estimate and the board resolution, the same needs to be reclassified in the books. Now let me look at, let me just touch upon the ISA 540R. I mean, this is not something which we as Institute has still adopted, but it talks about, this is an ISA 540R, which talks about the 10-step actually model for auditing the estimate. So what it talks about is that we as auditors needs to audit these 8 steps which management follows while concluding that there is a need for impairment in investment, or there is a need of no impairment in the investment. In terms of the risk management procedures performed by the management, as they have set the right roles and responsibility, this talks about basically on the control environment of the company. Determine the risk of material misstatement in terms of if something goes wrong. I mean, what is an impact on the financial statements? What are the test methods which have been used by the management? Okay, we need to test those assumptions which management has taken it. How the management has tested those assumptions and whatever data they have considered it. Have they involved experts? Have they involved specialists while arriving at the valuations? Okay, and how they've addressed the estimation of uncertainty and the disclosures which they have made in the financial statement. If we as an auditor are not comfortable with any of these 8 steps which is performed by the management, then we as auditors needs to do an independent test. Okay, and we need to start at point number 4 to say that we need to actually test the method ourselves to say that which method suits best. We need to also look at assumptions ourselves and specifically based on our independent data. We need to take the data and test those data independently ourselves. We need to evaluate the specialists and experts which are going to be working for us, and then follow the other steps and consider at the end of the day if there is a management bias while arriving at the conclusion. So this is the overall step which we need to follow while auditing impairment, because it is part of estimates. Okay, this is just a consideration in terms of what needs to be disclosed. I mean, in the consolidated financial statement, we need to ensure that all list of subsidiaries of the parent are disclosed with the name, country of residence, incorporation, share of ownership, and the share of voting powers. Uh, in case when you're doing consolidation, we need to also look at the subsidiaries which are not consolidation. We as auditors needs to look at the grounds where on basis which these subsidiaries are not consolidated, and is this permissible or not. If it is not permissible, then there will be an impact on our audit report, the way we sign off, right? I mean, effect of acquisition and disposal, as I said, is accounted properly. The details of investments have been put across. The name of the associates and other details are given in detail or not. I mean, by this, I mean, this is an overall conclusion in terms of how we look at investment at the end of the day. Any Q&A? I'll just move out of my screen so that we can open up for Q&A. Any questions?
Thank you so much for a wonderful deliberation, sir. You have justified with your deliberation presentation. Sir, due to the technical glitch, I am still in a position to fetch the questions, but I have received one question at the beginning. The question is relating to how the auditor of the parent company assess the impairment without proper access to books of accounts and records of the associate.
So there are 2 or 3 things when we look at impairment assessment. I think there are 2 points it is. One is we need to look at the historical information of that particular associate, right? Which is available through the audited financial statements of those associates as it move forward. The second point is on the, when we look at impairment test, we also look at the future recoverability of our investment in that particular associate and how we get in it. So I'm sure the management of the parent actually prepares a cash flow projection around it in terms of applying various assumptions and various estimates. So there is a two-way method to do it. One is we independently as a parent company test those assumptions in detail based on the supporting facts with the management gives, because these are future projections. Or we issue instruction to the parent auditor, I mean the associate auditor, to actually test couple of assumptions or 3 or 4 which you feel necessary and give back a report to say that how you as an auditor are comfortable with. So it depends upon how then parent auditor has to issue instructions to the associate auditor, and both the auditors have to work together to come up with a conclusion either ways.
And another question is, one member is asking just the gist to while auditing the investments, what precautions or what considerations will take, just he wants to know from your side, sir.
So I always say, sir, is that we also make investments, right? So I think forget about auditing standards for a while or Ind AS or let's think about if I am putting a money into a particular company, what are the 10 things which I'll take care? One thing I'll take care is that if I'm putting a money in a particular company, am I going to get a return in future or not? Have you done that assessment? So as an auditor, you need to test those assessments, right? Second thing, you will ensure that that investment which you are putting is in your name. So as an auditor, you need to see that that investment or the money which has been put in is in the name of the company. Third thing is, when you're mooking up money, you are taking approval for somebody, right? Either you as an owner or you have a, I mean, I've just put in our household, you have a father who gives it. So in this case, you need to ensure that the board of directors have approved that particular investment, right? Then you will get income, like I'm just taking an example, interest income, right? So you will calculate saying that, okay, if I have to get X amount, have I got X amount or not? The similar calculation management provides, and you need to test those particular things, right? So these are simple steps which you need to do. I think I mean, if you apply those simple steps, I think your basic test of investment gets over. Then little bit of complexity starts in terms of who holds that investment, how are you ensuring that investment is held in the right name, and all that complexity would start depending upon how the transaction is happening on the ground.
Fine, sir. Fine, sir. So thank you so much, sir, for sharing your valuable time and enlightening all of us on various intricacies while auditing the investments. On behalf of AASB of ICI, I extend my heartiest thanks towards you for sparing your valuable time and for a wonderful deliberation. Thank Thank you so much, Priyanshu. Thank you so much.
Thank you, sir. Thank you, sir.
Moving on, the next technical session, we are having with us our own chartered from our chartered accountant fraternity, C. Amit Jain ji, very learned speaker, and he is going to take the various auditing aspects while auditing the financial instruments. So I welcome on behalf of WSB of ICI Amit ji once again, and request you to please deliberate on this topic, financial instruments. Over to Amit ji, please.
Thank you, Anil ji. Thank you so much. Let me just present my screen. Anil ji, I'm just checking whether my screen is visible to you or not.
Yes, sir, it is perfectly fine. Perfectly fine.
Okay, thank you so much. Good evening, guys. First of all, I would like to say big thank you to Sanjeev Singhal ji, who has given me the opportunity to present my views in terms of financial instrument and its audit consideration to you guys. So let's start with the financial instrument, guys. For the next 1 hour, we will be discussing lots of things in this entire discussion on the financial instrument. This is my agenda, what I am going to discuss on financial instrument, guys. First is in respect of the overview of financial instrument. I have seen practically on the ground, guys, most of the people are struggling to understand what is actually a financial instrument is, right? What is the definition of the financial instrument, right? As Nilesh sir has said initially, that there are the different standard called IFRS 9, IAS 32, IFRS 7, and if I talk in terms of Ind AS, we have Ind AS 109, Ind AS 32, and Ind AS 107. So there are lots of things which is given in these three different standard, guys, right? So I've seen practically on the ground people are struggling. What is the basic understanding of financial instrument? So I will try to devote 5 to 10 minutes to give you a perspective with the help of very basic and simple example to understand what is a financial instrument, right? And then we will talk about the different instrument. I have summarized the different instrument in one slide with the overview of initial recognition accounting and the subsequent accounting, right? Then we will talk about the risk which an entity is exposed to in terms of the complex financial instrument, right? So complex financial instrument may be anything. For example, optionally convertible redeemable debenture, convertible preference shares, optionally redeemable preference shares, right? Optionally convertible debenture, optionally convertible bonds. So it can be any type of the financial instrument. Any instrument which involves hedge accounting, which involves derivatives, becomes a complex instrument to account for, right? So company is actually exposed to the risk when they enter into any financial instrument which is complex. So we will try to understand from the auditing perspective, from the auditor perspective, what are those risks which an entity is exposed to when they are actually entering into a complex financial instrument, right? Then we will talk about what are the key audit aspect, what are the key audit consideration in terms of auditing of the financial instrument in the financial statement, right? Then I have incorporated couple of case studies, guys. I have taken couple of case studies in terms of if a holding company has given a loan to a subsidiary, what should be the accounting and what are the key auditing steps which we should consider while auditing the transaction. Another example I have considered in terms of compound financial instrument, right? So what is the accounting of that compound financial instrument from the perspective of the financial instrument accounting, IAS 32, Ind AS 32, Ind AS 109, and what are the auditing consideration which an auditor should take into account while doing the audit of those compound financial instruments. Then I will talk about couple of areas which has been impacted due to the COVID in terms of financial instrument, right? And lastly, I will talk about certain areas, certain problems which has been identified by the FRRB, right? What is FRRB? FRRB is the Financial Reporting Review Board, which has been constituted by the ICI. What they generally do, they review the financial statement of the companies and they will identify whether it is correctly done or not. And whatever the observation they will identify, they just summarize it and issue in the market so that we people can focus on those and we can avoid those type of errors in the future years, right? So I will be focusing on all these aspects, guys, in the next 50 minutes to 1 hour, right? Okay, so let me start with, guys, what is a financial instrument, right? I have given the overview of different type of instrument here, but I will try to explain you with the help of my canvas what actually a financial instrument is, right? So what the standard setter has done, standard setter has taken these two words, one is the financial, second one is the instrument, right? What is the dictionary meaning of this word financial? Financial meaning is monetary value. Correct? Anything which is denominated in a monetary value is a financial. What is the dictionary meaning of word instrument? It's a contract, right? It's a dictionary meaning of the word instrument is a contract. It's an agreement. Correct? Now, guys, what the standard setter has done, standard setter has taken these two words and he has combined these two words and prepared a 180-page document which he has given name of IFRS 9 or Ind AS 109. So what I'm trying to say here is I am just going to have a meaning of these two words and I'm going to combine these two meanings and we will see that we are able to develop our own definition of the financial instrument, right? So one word financial, the dictionary meaning is monetary value and instrument is contract, right? When we talk about contract, have we ever read this word contract in our past life? Answer is absolutely yes. We have read this word contract in the Indian Contract Act, right? What the Indian Contract Act says that contract can be verbal, contract can be written, right? Contract can be verbal, contract can be written, but the contract has to be enforceable under law, right? What is that? Enforceable under law, right? And if I'm entering into a contract, guys, can I enter into a contract with myself which is enforceable under law? No. I can enter a contract with myself, but that is not enforceable under law. Can you guys enter a contract with yourself which is enforceable under law? No. So that means in order to enter into a contract, there must be at least two or more parties, right? At least two or more parties. So that means what is a contract? Contract can be verbal, contract can be written. Contract is enforceable under law, right? And there must be at least two or more parties. The terms and condition of the both parties must have been defined. That is what the contract is, right? Let's combine the meaning of these two words. Any contract which is denominated in a monetary value is called financial instrument. Correct? Let's extend our definition, what we have read here. Any contract which is verbal or which is written, but it is enforceable under law. Any contract which has been entered between two or more parties, which is denominated in a monetary value, is called a financial instrument. Right? So where we have reached, we have just said any contract which is entered between two or more parties denominated in a monetary value is called financial instrument, guys. Let me take a small example to clarify you. Let's say A Limited has entered into a contract. A Limited has entered into a contract with B Limited. What is the contract? A Limited is going to sell goods to B, right? Of rupees 1 lakh. And what the B is going to do, B has to pay 1 lakh rupees to A in terms of its consideration, right? So if I evaluate from the perspective of A, can I say the amount receivable of this 1 lakh rupees from B is nothing but a trade receivable from B, right? In the books of A, I can say this is a trade receivable because what is the accounting entry I will pass by making, by selling these goods? Simple trade receivable debit to revenue. So from the A perspective, it is a trade receivable, right? Now this trade receivable, can I say this is an asset? Everybody knows from the accounting perspective, trade receivable is an asset. Now, can I say this asset is denominated in a monetary value, which is 1 lakh rupees? Absolutely yes, because I'm going to receive 1 lakh rupees from B. This is an asset, this is a trade receivable. And since this asset is denominated in a monetary value, I can easily say this asset is nothing but a financial asset for A Limited. Correct? Now come from B Limited perspective. So B Limited has to pay 1 lakh rupees for purchase of goods. What is this? This is a trade payable for B. This is a trade payable for B, and everybody knows this trade payable is nothing but a liability for B. And since this liability is denominated in a monetary value, can I say this liability is nothing but a financial liability from B Limited? Right? So from where we have started, we just said any contract entered between two or more parties, which is denominated in a monetary value, is called financial instrument. Now apply this definition into this example. Any contract, is this is a contract? Yes, this is a contract, right? Are there two or more parties involved? Yes, two or more parties involved. So any contract entered between two or more parties which give rise a financial asset of one entity and a financial liability of another entity, that is called a financial instrument, guys. I'm repeating again, any contract entered between two or more parties which give rise a financial asset of one entity and a financial liability of another entity, that is called a financial instrument. That means in this example, this trade receivable is a financial instrument. This trade payable is a financial instrument because it is denominated in a monetary value, because there is a contract. There are two or more parties involved, and hence this contract, this small contract, becomes a financial instrument. Right? So earlier we used to say that this is a sale contract, this is a purchase contract, this is a receivable contract, this is a payable contract. And what should we should start using the word? We should start using the word, this is a financial instrument, guys. What has changed? Nothing has changed. Some jazzy word has come up, and earlier we used to use very simple plain vanilla English. Now we should start using this jazzy language. Right, guys? So let me take one more example. This is example number 2. Let's say A Limited has entered into a contract with B Limited. Right now, this contract has got changed in this example. This is example 2. Right now, A Limited has made an investment in B Limited of rupees 1 lakh, let's say. Right, what the B has to do? B has to issue equity shares. Correct. Now let's evaluate from the perspective of A Limited. Can I say this is an investment from the A Limited perspective? In the books of A, I will record this as an investment. Right? Is this investment an asset? Yes, we all know this investment made by the company is an asset. And this asset is denominated in a monetary value. Can I say this asset is nothing but a financial asset for A Limited? Right? Now come from B perspective. Now from B perspective, what accounting entry B is going to pass? B is going to pass bank account debit, right, to equity share capital, right? Equity share capital. That means from the B perspective, it is equity, right? This is equity. Now, what is the definition which we have brought up? We said any contract which is denominated in a monetary value is called financial instrument. Apply this definition into the second example. Is this is a contract? Is this investment a contract? Yes, this is a contract. Are there two or more parties involved? Yes, A Limited, B Limited. So any contract entered between two or more parties which give rise a financial asset of one entity and an equity of another entity, that is also called a financial instrument, guys. Right? So where we are? So first we said any contract which is entered between two or more parties denominated in a monetary value is called financial instrument. In the first example, which is debtor and payable example, sale and purchase example, we said any contract entered between two or more parties which give rise to a financial asset of one entity and a financial liability of another entity is a financial instrument. In the second example, which is an investment example, what we have said, any contract entered between two or more parties which give rise a financial asset of one entity and equity of another entity is also a financial instrument. Let's combine these two examples. Any contract entered between two or more parties which give rise a financial asset of one entity and either a financial liability or equity of another entity is called financial instrument, guys. Right? So this is the technical definition which is given under IS 32 or Ind AS 32 as well as under Ind AS 109. Right? And you can think of, guys, by having a basic 11th class example, by having a basic sale and purchase example, by having the basic investment and equity example, I think you guys have gained a lots of understanding that what actually a financial instrument is. And this is, believe me guys, this is what the definition of financial instrument which is given under IFRS 9 or Ind AS 109. Right guys? So that means trade receivable is a financial instrument, trade payable is a financial instrument, investment is a financial instrument, equity is a financial instrument. Right? So this is couple of example on financial instrument, guys. If I go back to my PPT, guys, and if I give you an overview of financial instrument, so we have discussed the definition of financial instrument. What is a financial instrument, right? Any contract entered between two or more parties which give rise a financial asset of one entity and either a financial liability or equity of another entity is called a financial instrument. Now, guys, this is the gist of the entire financial instrument, right? I have divided the entire financial instrument into the various sections. One is financial asset, second one is liability, third one is derivative hedging, and the fourth one is equity, right? Within a financial asset instrument category, right, I have divided the instrument into three buckets. One is primary instrument, second one is the debt instrument, third one is the equity instrument. And what can be the example of primary instrument? Primary instrument means simple, plain, vanilla, small, simple examples, right? What can be the example? Cash. Is cash a financial instrument? Yes, because there is a contract. When you read any currency, it's a contract between RBI and India, RBI and the person who is holding that currency. When you tender that currency to anyone, you have a right to receive something in place of that, right? So one party, it is an asset, for another party, it is a liability. Trade receivable, we have just discussed, it is a financial asset. Security deposit, I have given a security deposit which is to be refundable after 5 years, after 10 years, after 15 years, that becomes a security deposit. That is also a financial instrument. Loan and receivable, I have given a loan which is to be refundable after a point in time. That is also a financial instrument. Why? Because it is a financial asset of one party, financial liability of another party. Is there a contract? Yes. Are there two or more parties involved? Yes. That contract is enforceable under law? Yes. So this is a financial instrument, guys. Again, bank balance. Bank balance is also a financial instrument, guys, because it is my asset, and for bank, it is a financial liability. Have we entered into a contract? Yes, at the time of the opening of the bank account, I have must sign lots of forms, lots of agreements, terms and condition, which is called a contract, right? So bank balance is a financial asset, right? So what is the accounting of this primary instrument? If I am an auditor, what I need to see? How the company is doing the accounting, and and how do I need to see as an auditor whether that accounting is correct or not, right? So for that perspective, we should have a good understanding on the accounting part, plus what are the auditing step as well, which we need to consider from the auditing aspect. Correct, guys? So when I'm doing the audit of all these things, understanding is first. Understanding should be in respect of the accounting, right? So what is the accounting of these primary instrument? Fair value, right? So I need to record this cash, this trade receivable, this security deposit, this loans and receivable, bank balance at fair value. I means management has to record all these primary instrument at fair value. And subsequent recognition, amortized cost. What is amortized cost? Very simple, it is a carrying value, right? Under the previous gap, which is Indian gap, what is carrying value? Carrying value of a debtor. How to compute the carrying value of a debtor? Opening balance, addition during the year, that means sales made during the year, minus collection, minus bad debt, plus any interest if I'm charging from my customer, that becomes the carrying value. Here itself, that carrying value is nothing but a amortized cost, right? So what we are doing, earlier we used to say the closing balance of a debtor. Earlier we used to say carrying value of a debtor. Now we are saying it is an amortized cost, right? So some new JISI words has come up and we need to use those JISI words, guys, right? I'm not getting into a detail when it will be an amortized cost, when it will be FVTOC, when it will be FVTPL. So it requires significant time to understand. And so I'm not getting into the detail of all these things, but yes, from the high level perspective, I'm giving you an overview. Debt instrument, debt means any instrument whose nature is debt. Debt is loan actually. So I have taken a loan, that is a loan which I have taken, which is a debt. But it may possible I have made an investment whose nature is debt. That means investment in debenture, investment in bond. I have made an investment, it is an asset, but the nature of instrument is debt. That is investment in debenture, investment in bond, investment in instrument, debt instrument. What is the accounting? Fair value accounting. Everything, everything under NDS needs to be recognized at fair value except NDS 101, right? Because NDS 101 provides certain exemptions. So under IFRS 9, under NDS 109, under NDS 32, everything needs to be recognized at fair value on day one. What is fair value? Transaction price. What is transaction price? The arm's length price, the market price, which two parties have entered into, provided they are not related to each other, right? They are unrelated party who is willing to enter into a transaction, who has the reasonable skill to enter into that transaction. That is what the fair value is. So this instrument can be recognized at amortized cost. These instruments can be recognized at FVTOCI and FVTPL. What is FVTOCI? It is a fair value through OCI. OCI is other comprehensive income, right? What is other comprehensive income? Certain items, certain nature of items doesn't get recognized in P&L. It will get recognized in OCI, right? Which is not in the normal routine business of the company. For example, revaluation of PPE, actuarial gain and loss, hedge related item. Those items will not get recognized in P&L. Those items will get recognized in OCI. And here we are talking about fair value. Suppose I made an investment in the debenture of Reliance, 100 crore rupees, right? And I have taken a path of fair value through OCI, right? And as of 31st March 2022, the value has increased to 100 from 100 crores to 120 crores. So this 20 crore rupees will not go in P&L. It will recognized in OCI, right? That is what the OCI is. Then we have equity instrument. Equity instrument means whose nature is equity. For example, I've invested in the equity shares of Bharti Airtel, right? So that investment is in the nature of equity. It may possible that I have invested in the preference shares of Bharti Airtel, preference shares of any other listed company, preference shares of Reliance, debenture of Reliance, whose nature is actually equity, right? Which will get ultimately convertible into equity. And there are a couple of conditions which is given under IS 32 that fixed to fixed criteria needs to be satisfied. I'm not getting into the detail of fixed to fixed, but convertible debenture may be in the form of equity. Convertible preference shares may be in the form of equity and maybe in the form of liability as well, right? So it depends. So investment in equity shares, investment in preference share whose nature is equity, investment in convertible debenture whose nature is equity, the accounting will be fair value and subsequent accounting will be either FVTOCI at FVTPL subject to certain conditions attached to these categories. Correct. So this is the overview and the gist of financial asset related instrument, guys. If I come to financial liability, again, I have divided into three categories. First is primary instrument. Primary means trade payable, simple, bank borrowing, other borrowing, lease liability. This lease liability is coming from IFRS 16, Ind AS 116, right? If I've taken an asset on a lease, I need to repay the amount for that, right? That is what the lease liability. Mandatory redeemable instrument. For example, if the company has issued mandatory redeemable preference shares, very important example, under Indian GAAP, the moment company has issued the preference shares, which is mandatory redeemable, I will classify that instrument as an equity. I will pass the entry bank account debit to equity shareholder funds, right? And that preference share capital will be shown as a part of equity shareholder funds. But since this is a mandatory redeemable, that means company has to repay the money in future, maybe 5 years down the line, maybe 10 years down the line, maybe 20 years down the line. So that repayment, that preference shares will be reclassified from equity to liability under IFRS, under Ind AS, because It is mandatory redeemable. That is why we say we need to look at the substance of the transaction, what the reality is. Reality is not a capital. Reality is that I have taken a money and that needs to be repaid in the future. And whatever needs to be repaid in the future is never a equity. It's always a liability, right? So what is the accounting? Fair value accounting on day one and subsequent amortized cost, right? Or FVTPL as well, provided there may be a derivative. In this particular slide, I've considered derivative separately. Next is compound financial instrument. What is compound? Compound is very simple. For one party, it is a financial asset. For another party, it is either a it is both financial liability as well as equity. For example, optionally convertible preference shares, optionally redeemable convertible preference shares, optionally convertible debenture, optional compulsory convertible debenture, right? So there are multiple scenarios, multiple permutation combination can be possible when we are evaluating a financial instrument, guys, right? So initial accounting will be fair value and subsequent accounting will be split accounting. What is split accounting? I need to identify that out of 100 crore rupees, what is the amount of the liability and what is the amount of equity, right? So practically, how do? We compute the present value of the liability and the differential and the remaining number will be classified as equity. Puttable financial instrument. What is puttable? When the holder of the instrument has the right to put the instrument back to the issuer, that is called puttable financial instrument. In a simple sense, if let's say I made an investment in the startup, right, 100 crore rupees, and I have a right, and that investment is, let's say, equity shares or preference shares, and I have a right to sell that investment back to the company, back to the other shareholders of the company or to the company. That means I have a right. If I have exercised my right, company cannot say no. That means company has an obligation. That means it is called a puttable financial instrument. That is not an equity, that becomes a liability. So what will be the accounting? Day one, fair value, and subsequently fair value through P&L. Hedge accounting and derivative accounting. What is derivative? Call option, put option, futures, forward, cross currency swap, right? Principal only swap, interest only swap. So these are some of the examples of derivative. Derivative accounting, very simple, fair value, and fair value, right? Fair value only and fair value. What is hedge accounting? I can do the hedge accounting. Derivative accounting and hedge accounting are both different. If I'm adopting derivative accounting, I can't do hedge accounting. If I'm doing hedge accounting, I can't adopt derivative accounting. Choice. And whatever the choice management take, management has to disclose in its financial statement. Correct. Equity is always equity. It's a shareholder funds. Day one, fair value, and there is no remeasurement on equity accounting. So this is the entire gist, guys, on the financial instrument, right? What are the critical instrument, complex instrument, and what is the initial accounting and the subsequent accounting? I have tried summarizes various instrument and their accounting on the day one and subsequently in this one slide, right? Let's move on. Now we need to discuss what are the different risks which the company is exposed to. First is the market risk, right? What is the market risk? That because of the change in the value in the market, it may result into a gain or loss to the company, right? For example, currency risk. Let's say the currency USD prices keep on increasing. I have taken a loan from the foreign currency bank, right? Because of the increase in the dollar, I am incurring a loss because my liabilities keep on increasing, right? Interest rate risk. I have taken a loan in a foreign currency on which the rate is, let's say, LIBOR plus 0.5%, right? LIBOR is increasing, my liability is increasing, it is impacting my P&L, it is impacting my cash flows. Commodity risk. What is commodity risk? If I'm dealing in a commodity, gold, silver, agri commodity, the price is increasing or price is going down, it may impact my P&L, it may impact my cash flows. Equity price risk, volatility risk. So what is the market risk? Because of the change in the fair value in the market of a particular transaction or particular instrument, the impact, I'm having an impact in my P&L or on the cash flows, that is a market risk. So company is actually exposed to the market risk when they enter into the financial instrument, right? Credit risk. What is credit risk? Credit means I have sold certain goods to a third party. Who is my debtor? I need to recover the money, right? And the other party is facing lots of challenges, financial difficulty. His holding company is not supporting the party, right? That party is going to be a bankrupt, right? That party is not able to get the funding from the bank. So that party is facing a challenge. My debtor is facing a challenge. So I am having a big credit risk in my books of accounts. I need to create a provision for doubtful debt, which is termed as expected credit loss. So it may possible when I'm selling goods, I'm exposed to the credit risk. Liquidity risk. What is liquidity risk? That tomorrow I don't have much funding in my bank account. I am not getting the access from the banks. It may possible that I am not able to pay money. I am not able to repay the money to my creditors. I am not able to pay the money to my bankers, right? From whom I have taken a loan. I need to give a disclosure in my financial statement that what to basis on the today's scenario, what is my maturity profile of liability, right? I need to give a disclosure of a couple of ratios in the financial statement, which has been a amendment from MCA Schedule 3, right? That is what the liquidity risk which the company is exposed to. Another risk could be operational risk. It may possible while doing the accounting of the financial instrument, the accounting team of the company is not having that level of skills and capability to the day-to-day accounting of those financial instruments, right? They are not having the account, they are not having the skills and capability in doing the documentation. They are not having the skills and capability of doing the valuation or carry on the valuation model, right? So these are the significant risks which the company is exposed to, right? So while as an auditor, while doing the audit of that company, while doing the audit of the financial instrument sitting in the financial statement of that company, we need to take care of all these parameters. That yes, we need to be vigilant first of all, right? What type of company is having, whether their accounting staff, whether their finance team are capable of doing that accounting or not, what are the key risks which they are exposed to, and then we need to strategize our auditing principles accordingly, right guys? So these are the couple of risks on which I've talked about in terms of which the company is exposed to, correct? Okay, auditing aspect, guys. So what are the key auditing aspect when as an auditor we are doing the audit of the financial instrument of any company, right? So first is complex financial instrument. Whenever we see any complex financial instrument, includes derivative, optionally convertible debenture, redeemable preference shares, optionally convertible and redeemable debenture, dividend is discretionary, dividend is cumulative, and lots of permutation and combination are there. Conversion option may be available at the holder level, conversion option may be available at the issuer level, right? So there are multiple permutation combination in any financial instrument. We need to understand the purpose, very important. Why? As an auditor we need to raise a question, why you have entered into such transaction, what has changed because of which you have entered into a transaction, what is the rationale behind of entering into the transaction, what is the business model of the company while entering into this transaction, right? We need to understand that because we are talking about reality. In this IFRS we are talking about reality, right? Whatever the transaction is, we need to understand the rationale behind entering into the transaction. We need to understand what is the logics, why, right? And basis which we will be able to provide and do the audit of that financial statement accounting, whether it is correct or not. Correct. Second is understanding the different terms and condition. We need to have a good understanding of the financial instrument, guys. Different terms and condition. For example, cash flows. What is the expectation? What is the estimation and judgment which the company has considered in estimating the cash flows, future cash flows? What is the discount rate? What are the modification terms available in the instrument? Is this transaction entered into other arm's length basis, market price, right? What are the repayment terms? What is the interest rate? So these are the different parameters, different pointers which as an auditor we should be taking care of while doing the auditing of the financial instrument, right? Very carefully. Okay, what else? Use of experts. We need to we are an experts on accounting, guys. We are an experts from the auditing aspect, but we may not be an expert from the valuation perspective, right? So let's say there is a derivative, let's say there is an embedded derivative, let's say there is a hedge accounting. It may possible that we need to reach out to the company and we will ask from the company that this needs to be fair valued, and we need a valuer, right? Merchant valuer kind of thing, on the basis of evaluation, whether the valuation has been done correctly or not, right? So whatever the valuation given by the company, whatever the valuer which the company may involve, we need to also check whether that valuer is capable of doing the valuation of that financial instrument. What are the assumption which the valuer has taken? What are the estimation which the valuer has taken? We should also start challenging the valuation report, right? When you are raising your voice, things will start popping up, right? So we need to involve we need to involve experts on the financial instrument side, guys. Valuation methodology. Under Ind AS 113, it only talks about the valuation methodology, right? For example, market approach, cost approach, income approach, right? It briefly touches upon all these approaches, right? So when we are doing the auditing and reviewing the valuer report, we need to raise a question basis this approach which is given under the Ind AS 113, whether the estimation has been consistently used or not, whether the assumption is reasonable or not, right? Whether the financial model used by the valuer is reasonable or not. We need to start challenging those assumptions. We need to start reviewing and we need to start auditing those assumptions, judgments, and other things which has been considered by valuer. It is not a case, guys, the valuation report has been obtained by the management and my objective is over. No, we need to challenge that valuation report, right? Similarly, the various inputs used by the valuer, we should start reviewing those inputs and start challenging those if they are not proper. We need to obtain appropriate audit evidence on each and every aspect, and we need to document that as well. Documentation is very important, guys, very, very important. Offsetting. Can we offset financial asset and liability? Can we offset other assets and liability? No. Can we offset revenue versus expense? No. Otherwise, I just recognize only the retained earning. Can I offset trade receivable versus trade payable? No. But there are couple of guidance which is given under different standard. I can offset. For example, provision for doubtful debt can be offset from the trade receivable. Provision for obsolescence of inventory can be netted off from the inventory. Deferred tax asset can be netted off from the deferred tax liability, provided it pertains to a single jurisdiction. Similarly, financial asset can be netted off from the financial liability, provided these two conditions get satisfied. One is company's legally enforceable right to set off, and the intention is to settle the financial asset and liability on a net basis. Ultimately, in a nutshell, we are saying if the company is operating as an agent on behalf of the another, then we can offset a financial asset versus financial liability. So as an auditor, I should be very vigilant that whether the transaction needs to be recognized on a gross basis or a net basis. Whether the view taken by the company on gross or net is seems correct, whether we have the appropriate audit documentation, appropriate audit evidence to ensure it needs to be offset or it not need to be offset. Correct. What else? Consistency. We need to ensure the valuation method used by the actuary or by the company is consistent over the period, right? And we should start challenging the different things used by the as an input in the actuary or the valuer report. CVOP assumptions, completeness. We need to ensure that all the disclosures have been done, all the information and terms and conditions have been captured while doing the accounting. Existence, transaction exists. Accuracy and valuation. Valuation is proper, right? Obligation, presentation, that all the events have been disclosed by the company. Presentation, appropriate presentation has been made by the company. We need to ensure Ind AS 107 has been properly implemented, properly applied while giving a disclosures in the financial statement. ICA has issued ICA has issued a checklist, which is a disclosure checklist, guys, in the way back, right, in respect of each and every standard. Right, while doing the auditing, we generally fill that checklist to ensure that all disclosures have been appropriately disclosed in the financial statement. I think I'm not sure whether people are actually using on the ground or not, but if not, we should be start using those checklists. Those checklists has been actually prepared from the perspective auditor as well as from the management, right? Or as an auditor, you should be asking from the management whether you have filled the checklist, whether are you comfortable that all the requirements given under the respective standard has been disclosed in the financial statement or not. And you should be start reviewing those checklists filled by the management, right? So that additional procedure we need to consider. Professional skeptics, we need to consider that all the judgments, estimation, internal control environment, we need to evaluate whether the information system IT technologies are capable to capture all those information or not. And we need to, depending upon the same, we need to comment in Caro, guys. Right. So these are the some of the key impact areas or key auditing consideration in the financial statement of or the auditing of the financial instrument in the financial statement of the companies. Okay, guys. So now I have taken one example, one case studies, interest-free loan, right? So interest-free loan. So what I have tried to explain this particular slide, that if a loan has been given from a holding company to its a subsidiary company, which is interest-free. First of all, what is the accounting implication in the holding books? What is the accounting implication in subsidiary books? And what is the audit consideration? Right? So we are just saying a holding company has given a loan of rupees 1 lakh for the period of 5 years to subsidiary company, and the market rate of interest is 10%. Right? So what should be the day one accounting? Day one accounting is holding company will recognize a loan to subsidiary, right, to bank 1 lakh, and but this loan will be at fair value or present value, and this difference will be recognized as deemed investment. Deemed investment, right? That we will assume this benefit which has been passed on to the subsidiary is nothing but a deemed investment. This requires a separate disclosures, right? And in the books of subsidiary, bank debit to loan and to capital contribution. To capital contribution. And what is the key auditing aspect? Rationale, why this transaction has happened. Verify the detailed terms and condition. Methodology as per 113. Discounting rate. It may possible the discounting rate of the holding company and subsidiary company are different, right? So whether the different discounting rate has been used or not. Estimation involved in the estimation judgment involved in the cash flows. Evaluation of the classification, whether it is an amortized cost, FETOCI or FETPL. Elimination in the console, whether this transaction has been appropriately eliminated in the console books, whether the deferred tax has been appropriately considered in the console books or not, right? What about the taxability of notional gain and loss? First of all, this notional gain and loss is not taxable, not deductible in the income tax, but whether has company has considered the correct treatment in the income tax or not, right? Presentation of deemed investment, presentation of deemed capital contribution, and other disclosure of Ind AS 107. So guys, the only point which I'm trying to highlight is we need to think slightly widely, not only from the perspective of the company that this is what needs to be done by company. We need to think slightly widely that these are the 10 things apart from this basic thing which we used to do under Indian GAAP. Lots of disclosures, lots of subjectivity, lots of judgment, lots of estimation as well, which is involved in the disclosures accounting under financial instrument under Ind AS. Right. Similarly, I have taken one more example, guys, in terms of compound financial instrument, where the where a transaction has been done in terms of convertible bond, but there is a redemption option without conversion option. Right. So in this case, what we need to do, we need to divide this number into liability as well as equity. Equity is always a balancing figure, and liability is a present value of the future cash flows. So what we need to check? We need to check the rationale. We need to check the terms and condition. We need to check the valuation methodology as per 113. We need to check the evaluation of IRR, internal rate of return, effective interest rate. We need to evaluate the judgment and estimation involved in the discount rate, estimation of conversion. We need to evaluate FETPL accounting, FETOC accounting. We need to evaluate the deferred tax impact. We need to evaluate the interest accretion done by the company is correct or not. We need to check the presentation in the financial statement. We need to check whether the appropriate disclosures has been given in the financial statement or not. So lots of things needs to be done from the auditing aspect as well. Correct, guys. These are the couple of case studies which I have tried included here. Right, let me move forward. We have limited time, guys. Couple of parameters I have included here from the perspective of the Caro impact on financial instrument. Right, first is moratorium of principal and interest. So if the government has provided the moratorium of principal interest, whether it should be considered as a default on the reporting date, it will not be considered as a default on the reporting date. Right, because as per schedule 3 and Ind AS 1, if there is any default, we need to disclose that default on the reporting date. But it is an extension by the government, it will not be considered as a default. Second question is how to account for moratorium of principal and interest. Right, so accounting is if there is a modification, substantial modification, then extinguishment accounting needs to be done. Original loan needs to be closed in my books of accounts. New loan needs to be recognized, and the differential will be recognized in P&L. So guidance is if where the modification is substantial, right, then I will close my old liability at carrying value. I will recognize my new liability at fair value, and the differential will go in P&L. But if the modification is not substantial, that I will adjust that amount in the gross carrying value. Right, what else? Classification of borrowing in FS, COVID impacted. So classification of the borrowing. So what is the requirement under Ind AS 1, under schedule 3? If the long-term loan has been taken, right, and there is a default on the breach of covenant, right, then it should be classified as current. Right, but if the lender has agreed not to demand the loan, even then it will still be classified as non-current. This is a carve out between IFRS and Ind AS. So what we are saying is if it is a minor provision of covenant, minor provision of breach, right, then it will continue to be recognized as non-current. But if it is a major provision, it will be recognized as current. Now the judgment involved, what is minor, what is major? It depends upon the materiality, it depends upon the judgment, subjectivity, and the call needs to be taken between auditor and the management. Right, so we should be skeptical, we should be vigilant that what is happening on the ground, guys. Right, whether the accounting done by the management is correct or not, because we are signing the audit report, we are signing the financial statement. So whatever the done by the management, we are agreeing by signing the financial statement of the company. Right, COVID impact on ECL. ECL is again one of the gray area where it involves lots of judgment. Right, it depends upon the probability of default, it depends upon the exposure at default, it depends upon the loss given at default. Right, so whatever the assumption which the company has considered, we need to consider that as well. Whether the entity is required to make changes in the provision metrics in simplified approach. Yes, absolutely yes, because it may possible due to the COVID environment, the risk metrics, the credit risk of that person keeps on changing. He may start doing the default in making the payment to me, so the credit risk will keep on increasing. Right, so the provision metrics which I prepare in the simplified approach will keeps on changing. Right, estimation, very important aspect, guys. This is a standards of auditing 540, right, which provides the guidance on auditing of the accounting estimates. Right, so what are the different estimates? For example, impairment of investment. In the previous session, guys, Priyanshu session, we have gained a good understanding how to do the impairment of the investment. Right, impairment of trade and other receivable, expected credit loss, assumption used in the future cash flows. We need to do the audit of assumption, we need to do the audit of impairment, we need to do the audit of different inputs which the company has considered while doing the impairment. of investment and trade receivable. The discount rate used by the company, we need to do the audit. Why this is the discount rate? Why the other approach is not suitable in this environment? Recoverability of deferred tax, penalties. Is there any penalty involved? We need to evaluate the terms and condition of the contract. Modification, termination benefits, if any, right? So we need to be vigilant. We need to apply the principle of auditing while doing the audit of the financial instrument, while doing the audit of the estimates, while doing the audit of the judgments involved. Correct? Let me move on quickly, guys. This is the last section in my discussion. FRRB comments, Financial Reporting Review Board comments, right? So what they've done, they have reviewed the financial statement of various companies over the period, and they've come across certain observation only in respect of financial instrument, which I've captured here, but they have released a publication which contains the observation on the various section of the financial instrument, right? For example, incorrect presentation on the fair valuation gain on investment, which has been classified at fair value through P&L. So requirement is, if there is a gain on the fair valuation, that needs to be recognized in P&L, and that will form a part of operating income, that will form a part of other non-operating income within the category of other income. But what they have observed, that the company is recognized directly in the other income, right? So it is actually a non-compliance of Schedule 3 that needs to be taken care of by the company going forward. Incorrect accounting of the forward contract. The company has taken a certain forward contracts, right? But they have applied AS 11 accounting under Ind AS. AS 11 is Indian GAAP accounting, but they have already adopted Ind AS, and while doing that accounting, they have applied Indian GAAP accounting under Ind AS, right? This is absolutely wrong. This is absolutely wrong, because under Ind AS we need to apply derivative accounting or the hedge accounting, right? Derivative fair value through P&L and hedge account is a different concept, slightly complex as well. Again, this is a non-compliance of Ind AS 109. Incorrect accounting policy on the reclassification of forex gain and loss. So company has given a wrong accounting policy, right? So in the group financial statement, the company has given a wrong accounting policy. It's a non-compliance of 109. It's actually a non-compliance of Ind AS 21. Right? So at the time of writing accounting policy, guys, we should, as an auditor, we should be vigilant. We should have a good knowledge on the subject matter, that what accounting policy is written in the accounting policy section, whether that is correct or not. Another point, incorrect presentation of forex gain and loss. So forex loss needs to be recognized in the other expense as per the guidance. If there is a forex expense, forex gain, it will be recognized as a part of other income. But what the company has done, company has reduced the expense from the income side. Incorrect presentation, guys. Incorrect presentation, non-compliance of the ICI Schedule 3, non-compliance of Schedule 3 and ICI guidance note. So guys, my only suggestion is, as an auditor, we should be vigilant. We should think wide. We should audit each and every aspect of the financial instrument. It is not a case that we should only audit the accounting done by the company. What are the inputs which has been used by the company? What is the valuation strategy? What is the valuation model? What is the business rationale? What is the business model test of the company? Right? Whether the company has done the correct accounting or not. And most importantly, what is the accounting policy written in its accounts, whether that in compliance with Schedule 3, whether that is in compliance with ICI guidance note, whether that is in compliance with accounting standard or not. All these parameter, guys, I think we should be focusing on all these parameter in terms of auditing the financial instrument, guys. So this is from my side. Anilji, if we have any question, I will be happy to answer on that. Anilji?
Can you hear me, sir?
Yes, I can hear you.
Yeah,
I'm just
thank
checking
you so
if
much.
there is any question. I'm happy to answer that.
Sir, thank you so much for a very, very, very detailed and very, in a very lucid manner. You have started with the definition of the financial instrument. It was really marvelous the way you have explained the definition of the financial instrument with the help of the example, as well as followed by the various case studies you have taken in your deliberation. Thoroughly, I have gained a lot through your deliberation, and hope our members have also gained a lot through your deliberation. But due
Thank
to
you
the
so much,
technical
sir.
glitch, as I have shared with Priyanshu ji, we are not able to today to fetch the questions. But definitely we will receive the questions, and definitely I'll mail you, and the answers will you which you will provide us, we will forward to the concerned member. So
Sure,
it
sir.
is a
I will
time.
be
Yes, sir. Yes, sir. Yes,
I
sir.
will
Yes,
be
sir. Yes,
happy
sir.
to answer all those queries which we will receive subsequently.
Yes, sir. Yes, sir. Thank you so much. And it is my sincere thanks to you. Whenever I approach you, you are always available for the cause of the profession as well as for the members. As well as first time I have approached to Priyanshu ji, immediately he has given his kind consent to deliberate on this topics. Specifically, he has suggested to take the investment, and you have suggested for financial instrument. So it was really nice to have both the speakers over here. On behalf of AASB of ICI, I extend my heartiest thanks towards both of you for sparing your valuable time and enlightening all of us at this particular time where you all both are supposed to be with your family, and you are deliberating for our members. Thank you so much. And in the absentia for our honorable past present sir Nilesh Vikamseji for his valuable time and enlightening all of us. Thank you so much, sir. Thank you so much.
Thank you
Thank you,
so
sir.
much, sir. Thank you so much.
Thank you.
Thank
Thank
you
Thank
you.
so
you.
much. Thank you, sir. Thank you.
Thank
Good
you,
night.
everyone.
Good night.
Bye bye.
Thank you.